People keep talking about a deal, and when we talk about a deal, it's usually in the context of what China have to do. China will buy more products. China will relax some of the rules when it comes to technology transfers, foreign ownership. China will address structural reforms. It's all about what China is doing. What is the US going to offer?
Well, this we have to see. First of all, no more tariffs. That's what our key assumption is at this point, and I think that's a very important assumption, not just for Asia or China, but for the global trade, which was really hammered in the fourth quarter and also at the beginning of in January, if you see the January numbers, for example, out of Korea. So I think that's a big positive news where the market is speculating on it, but we also could imagine that, as said, we heard from Mr. Trump already, maybe a bit of a softer tone out of the US when it comes to some of the core technologies, and I think that would be very important. Less scrutiny on some of the imports that are coming out of China, and I think that would be a major development. If you look at last year, that was really weighing on the market, so the trade worries that was weighing on the market has pushed it down, and if we remove that, I think we have one of the big hurdles actually out of the way, and then markets look actually quite attractive from where they are currently, how they are valued, and how the investor sentiment is currently.
So I read in your notes before the show that you actually started getting long Chinese indices towards the end of last year. So congratulations on the timing. I mean, why did you get involved then? And are you turning a little bit more cautious now, given how much we've moved in the first couple of months of the year?
Yeah, so we bought in December the onshore Chinese equity market, and it was really main three reasons. First of all, we saw actually that the trade tariffs starting to impact also US growth and particularly investor sentiment. And we were expecting that there's a shift out of the Trump administration to find a deal, at least on the tariff side, maybe less on the intellectual property side, but the tariff side where we were expecting better developments, which are now materializing. And at the same time, markets were actually cheap. Investor sentiment was very, very sluggish at this point. And we are contrarian by nature, so we like to pick up some of these names and some of the markets where investor sentiment is most bearish. So that has worked well. Looking what happened over the last couple of weeks, we had a very strong rally. Onshore markets are up 15% year to date. Yes, so we want to be a little bit more cautious. We started to lock in some of the profits, but we remain overweight. We remain overweight in China. We remain overweight in Asia ex-Japan, because we still do think that with less worries on the trade side, less worries also on a hawkish Fed, sentiment actually hasn't really recovered. So if you look at the flow side, even our internal clients, not many clients have bought during the January. So this wall of worry that we usually climb hasn't really happened. And that suggests to us that there's more upside over the next couple of months. And therefore, we want to be engaged into these markets.
Hey everybody, it's Hadley Gamble from our new CNBC Middle East Bureau in Abu Dhabi. Thanks for stopping by. Now to watch more, you can try one of the videos that just popped up on your screen. And don't forget to subscribe.